Polestar is supposed to be one of the best EV companies on the market. This is a company that has operations in several countries around the world. They have produced 3 models to date and will have 5 models in the next 3 years. Yet the share price keeps dropping and is now down over 60% from its high back in June. Fundamentally, Polestar is fantastic. They have set delivery targets which would rank the company second only to Tesla in the pure play EV industry, and have hit all their sales and expansion targets so far. So why are their financials so bad at the moment, and is this the reason the share price is dropping? Overall, the question is, what the hell is going on at Polestar, and what does this mean for PSNY shareholders? Plus, why is legendary activist investor Paul Singer beginning to invest in Polestar now? What's up investors, and welcome back to another Polestar update, ticker symbol PSNY. In this video I will look at each of these points and analyse how the hell we have got into penny stock status for such a massive global company. So if you enjoy my Polestar videos and want me to create regular updates, can I ask you to smash the like button? By liking the video and dropping a comment, you are letting me know that you want to see more of this type of PSNY content. I'm aiming to get 200 likes again on this video. Help me achieve this goal. It literally costs you nothing, but it helps me out so much. Subscribe to the channel if you're new and hit the bell notification. Now let's get into it with some of the latest news. Since my last update, Polestar have announced their Q3 sales figures. Polestar announced that its global sales amounted to 9,215 during the third quarter of 2022. The goal for 2022 is 50,000 units, which was originally 65,000. So almost 20,000 units would be necessary in Q4 alone to meet the target. It would be a significant new quarter record, and I will discuss this more in just a moment. But Polestar CEO Thomas Ingenlath seems very confident that this can be achieved. The majority of Polestar 2 cars set for delivery in Q4 are ready and making their way to customers in 27 markets around the world, with the fourth quarter set to be our strongest on record yet. I am confident that we will meet our target of 50,000 cars for this year. And this was announced just days before Polestar unveiled their new Polestar 3, which is their first SUV, which achieves over 500 horsepower. Now the official unveiling of this EV has been highly anticipated, but I am a little bit concerned about the starting price. Only one version of the Polestar 3 will be available at launch, though less expensive trims are expected to follow, but this version has a price tag of $84,000. Now this is quite a step up in price from what will likely be its main competitors. Tesla's Model Y, which costs about $70,000 for the similar dual motor trim, and another potential rival, BMW's all-electric iX SUV, which starts at $85,000. And to be fair, these are two companies that already have broad global market appeal, strong history, and massive consumer confidence. So I think this price is a bit of an ask for Polestar. Now Polestar has attracted the interest of an activist investor in the shape of Paul Singer's hedge fund Elliott Management, which I will look at in just a moment. But first I want to look at this very well written article on Seeking Alpha. While I will also be looking at the investor's presentation and the Polestar financials to try to make sense of why the share price is continuously dropping. So this article was written last week. At $5, is Polestar an opportunity or a trap? Polestar is currently an EV startup that boasts one of the best production and delivery numbers with slim positive gross margins, yet trading at a significant discount to its peers. Uncertainties over its current capital structure and profit realization timeline remain a large overhang on the stock. And this analysis also looks at Polestar's near-term catalysts and Polestar's biggest risks to watch out for. So obviously, in today's market, we have seen everything crashing over the past few months as inflation goes through the roof and the Fed are actively hiking interest rates to curb this. And stronger than expected jobs data in the US that reinforced wages for more aggressive rate hikes by central banks over the coming months to cool markets and inflation, which would imply further turmoil on corporate growth, profitability, and valuations in the near term. The sell-off continues to underscore elevated market fragility and sensitivity to uncertainties over the near-term macroeconomic outlook, which bodes unfavorably for stocks like Polestar that remain immediately unprofitable under a market climate where investors' preferences are shifting from growth to near-term cash flows. So it is becoming an issue now for Polestar, where both inflationary pressures and rising borrowing costs now risk derailing its profitability trajectory. And I will compare this with the financials in just a moment. Right now, an issue of equal measure is the delivery progress. Polestar have delivered 21,000 vehicles in the first half of the year, but only 9,000 in Q3. For the current quarter, the company remains about 19,600 vehicles out from reaffirmed full-year delivery guidance of 50,000 vehicles, representing a required weekly run rate of more than 1,490 vehicles, which is close to double what they have achieved in the third quarter. Now, this is something that I am always skeptical about. When I see a company maintaining that they can double their sales quarter over quarter, it tends to be all talk. But I think that in this case, it's different. Recent remarks from Polestar CEO Thomas Inglett suggest that the company has already doubled their output in the current quarter to catch up on lost output during the COVID lockdowns earlier this year. Reaching its full year delivery target is still very much within reach. Now, this is crucial. I think Polestar need to hit 20,000 vehicles this quarter and hit 50,000 for the year, or else it will seriously damage the stock price even worse than the past 2 months. Remember their investors' presentation. Polestar is aiming for 50,000 this year, but they are aiming for 124,000 next year. That means an average of 31,000 vehicles from next quarter onwards. If they cannot hit 20,000 in Q4, I highly doubt that they will be hitting these targets either, and this does need to happen. So if you've watched this far into the video and you enjoy my Polestar related content and want me to keep creating regular updates, can I ask you to smash the like button? By liking the video and dropping a comment, you are letting me know that you want to see more of this type of content. Subscribe to the channel and follow me on Twitter too, all links in the description below. And this article does highlight some good points. And to be honest, this is a point that I would never have really considered, but it is a good point. Port congestions in China, due to its on-off COVID restrictions, also risks derailing Polestar's risk-reward payoff if it decides to press forward with its full-year delivery targets at all costs. Despite a recent decline in ocean booking levels in China, due to a slowdown in manufacturing orders in recent weeks, they remain elevated compared to trends observed prior to the pandemic, with export freight rates still at all-time highs, challenging Polestar's bottom line given all of its worldwide inventory across 27 markets stems from the manufacturing facilities based in China. As these costs continue to stay high, the company faces risks of delayed profit timeline that could potentially lead to further volatility in its shares over the coming months as market conditions weaken. Now, considering some near-term catalysts for Polestar, the debut of the Polestar 3 SUV, alongside an increasing mix of vehicles sold under its new pricing model introduced in recent months, are expected to cushion some of the anticipated pressure on its profit margins. And the Polestar 3 will open doors for Polestar to compete in one of the highest margin and growth segments across the US and Europe. The only issue that I have with this is that the price could possibly hinder sales. I mentioned this already, going up against the likes of Tesla and BMW in markets where these are tried and trusted brands, and trying to compete with these at a more expensive price could be a huge challenge for a startup like Polestar, and this could prove to be a mistake in my opinion. But my main concern for Polestar is this, and I feel that this is a main concern of many investors who look at Polestar. Aside from the $1.4 billion in cash as well as credit facilities that provide it with access to another $345 million to support working capital needs, Polestar's liquidity position at the moment is relatively weak. This is consistent with CEO Thomas Inglett's continued evaluation for funding options including both debt and equity to fund Polestar's working capital needs. Looking back at the most recent financial statements, we can easily see that the situation is not good. Yes, they have $1.38 billion in cash and total assets of $1.8 billion, but the total current liabilities is $2.5 billion. The fact that this is current and not long-term is a big issue for me. These are liabilities that need to be settled within 12 months, and that would not be too bad if Polestar was profitable. But is Polestar profitable? In short, the answer is no. In the first 6 months of the year, they made a loss of $500 million. And this actually looks better than the reality of the operating loss being nearly $885 million. So the money that Polestar does have won't be lasting too long. Looking back again at the investors' presentation, Polestar need to hit the sales figures so that they can achieve these revenues. Their gross profit of $53 million for the first 6 months of the year is not good enough. They need to get 5 times this in the second 6 months to achieve their target of $300 million gross profit for the full year. And although their losses are substantial this year, Polestar expects to be far less next year. A loss of only $200 million for the full year 2023. At the moment, this all looks very unlikely, and we can see that being reflected in the share price. Polestar likely faces the need for additional fundraising within the foreseeable future, and this would not be an ideal undertaking under the current market climate. Considering elevated borrowing costs that could potentially further weigh on Polestar's tight margins, and a broad-based slowdown in the corporate bond and equity markets that would make the securities issuance difficult in the near term. To be fair, share dilution at this price would be a real kick in the teeth for all Polestar investors, and if they do dilute at an even worse price than this, I'd be lost for words. But there is one saving grace here. Polestar benefits from the support of its parent companies, Volvo and Geely. From both an operational and funding perspective, overall, Volvo owns about 50% of Polestar, and these are established and profitable companies. This is the latest set of financial statements from Geely Automotive, who also own Volvo. They have 82 billion in gross net assets and 37 billion in cash and bank balances. This equates to just over $5 billion in actual cash. So it is likely that Polestar will get support from its parent company who can well afford it. But Polestar's upcoming Q3 earnings report will be vital to the company and hopefully can improve investor confidence. Now, to wrap this analysis up, there is the positive note that Polestar continues to sell every car that it makes with strong momentum in global order take. This EV maker is likely already benefiting from growing brand traction across its global operations, so once supply chain issues are fixed, hopefully they can achieve their targets. But Polestar remains victim to market unforgiving sentiment of fear at the moment, the Fed are raising interest rates, and with inflationary pressures that are poised to impact industry-wide profit margins in the near term. Polestar stock will likely remain an underperformer in public markets and trade at a sub $10 level in the near term. The stock remains a favorable investment from the long-term perspective, but until there is greater visibility into the capital structure and the alleviation in monetary policy tightening, Polestar stock will be subject to further volatility that can unleash a lower drop. And finally, Paul Singer's hedge fund, Elliott Management are beginning to build a stake in Polestar. Now, why is this a notable development? Elliott Management is one of the oldest fund managers in the US with over $55 billion in assets under management as of June 30th, 2022. And Paul Singer, the founder and CEO of Elliott Management, is among the most recognizable activist investors on Wall Street, known for his aggressive approach in turning companies around. Singer and Elliott Management have targeted several big-name corporations including Samsung, AT&T, Twitter, and Italian football club AC Milan. Now, his position in Polestar is still tiny, only accounting for about 0.3% of Elliott's total portfolio. So only time will tell if Singer and Elliott Management will choose to campaign for control of Polo. Now, I will be keeping an eye on this to see if Elliott are adding to this in the coming months. But what do you think of having the likes of Paul Singer getting involved here? Drop a comment and let me know what you think. And if you're new around here, hit the subscribe button and bell notification and follow me on Twitter. But remember that I'm not a financial advisor, this is not financial advice. Subscribe and I'll see you in the next update.